Hey everyone, welcome back to Corporate Decoder. Today we're diving into some financial dealings that might make you think twice about who's paying who. It's like finding out your favorite influencer is secretly sponsored by a company you hate. We're looking at a report from Surf Air Mobility, and it involves some shares, some services, and a pretty big name in tech. Here's the scoop. Back in March of 2025, Surf Air Mobility decided to pay for some services in a rather unusual way. Instead of handing over cash, they issued shares of their own stock to Palantir Technologies. Think of it like trading company scrip at the company store. In total, 244,011 shares changed hands. Now, what's the big deal about that? Well, those shares were valued at around ALD $0.9 million. That is less than $1 million. So Palantir provided services to Surf Air, and instead of getting paid in dollars and cents, they got a piece of the company. Why is that important? Because it means Palantir now has a vested interest in Surf Air's success or failure. Now, the legal bit, Surf Air is saying they didn't have to register these shares with the Securities and Exchange Commission or SEC because they were relying on something called Rule 506 of Regulation D and Section 4.2 of the Securities Act. Basically, these are exemptions that allow companies to sell stock without all the usual red tape, generally because it's being sold to sophisticated investors who can fend for themselves. It's like saying, don't worry, these guys know what they're doing. So what kind of services did Palantir provide that were worth almost $1 million in stock? The report doesn't spell it out, but Palantir is known for its data analytics and software platforms. It is reasonable to assume Surf Air needed help crunching numbers, improving efficiency, or something along those lines. Now for my analysis. Airfare is essentially paying for services with its own equity, which can be a double-edged sword. On one hand, it conserves cash, which is always good, especially for a company that might be struggling. It can also align interests, making Palantir a partner in Surf Air's journey. But there's a downside. Issuing shares dilutes the ownership of existing shareholders. It's like cutting a pizza into more slices, everyone gets a smaller piece. If Surf Air keeps doing this, the value of each share could decrease, hurting the people who already invested in the company. The big question is Palantir's expertise worth that cost? Is the value of their services to Surf Air worth the dilution of shares? That's what investors need to consider. Is Surf Air getting a good deal, or are they giving away too much of the company for services they could have gotten elsewhere, maybe for cash? Palantir's involvement could be a sign of confidence in Surf Air's potential, or it could just be a smart business move by Palantir, getting a stake in a company they believe they can help turn around. Either way, it's a deal that could have a ripple effect on Surf Air's future and its investors' pockets. In conclusion, this report highlights an interesting transaction. Surf Air is bartering its stock for services from a major player in the tech world. While it might help them in the short term, it also raises questions about the long-term impact on shareholders. Thanks for watching. If you found this breakdown helpful, please hit that like button, leave a comment, and subscribe for more insights into the world of corporate filings. Until next time.